evening, sir.
Good evening.
Good evening.
Good evening, Rajendra.
Kem cho?
All well, all well.
Yeah. Okay.
Yes. Good evening to everyone, and I welcome to all the members to the budget session, which is being. It's a big privilege to have you, sir, here after a very long break, and all Nasikites were very eager to hear you. And again, on this platform, I request for your personal visit also to the branch and hear you. Now, going ahead with the session, I request our chairman, Rajendra Shete, sir, to give his opening remarks and start today's session.
Thank you, Abhijit ji. Good evening to all and welcome on this virtual program on the budget 2022. At the outset, I would like to welcome today's speaker, CA Rajan Vora, sir, who has joined the Nasik branch after, we can say, long time. Welcome, sir, at Nasik branch of WRC. Yesterday, the finance minister presented the budget for the year 22-23. And now it's the time to understand the amendment in direct tax. So today, Rajan Vora sir will discuss key direct tax provision. Nasik branch will also plan another session on the budget amendment on indirect tax also. And we will declare that session shortly, most probably on the Saturday 5th, we'll plan this session on amendments on indirect tax in this budget. Now I request Nasik branch Vice Chairman C.A. Soil Shah to introduce today's speaker. Over to you, Soil.
Thank you, sir. So again, as said by Abhijit sir and Rajendra sir, it's my privilege to introduce our today's speaker, a legendary person, C.A. Rajan Vora sir. He heads, this is just a short introduction. He heads Uae India's direct tax litigation practice and is partner of member firm of Uae Global, presently Mumbai-based firm. He has extensive experience in representing tax litigation matters before the Income Tax Appellate Tribunal and Authority for Advance Ruling. His experience includes more than 4 decades in litigation and corporate tax advisory service, including transfer pricing and international tax issue. He was the president of Bombay Chartered Accountants Society in 1991. He has authored several publications of professional organizations like that of Institute of Chartered Accountants of India, Bombay Chartered Accountants Society, and Chamber of Tax Consultants. He was chairman of Direct Tax Committee of IMC Chamber of Commerce earlier for 4 years, and is also chairman of this committee in this current year. So with this short introduction, I request Rajan sir to address the members on the given topic. Over to you, sir.
Thank you. Thank you very much. Thank you, Rajendra, the chairman of the Nasik branch, Sohail, Rakesh, Abhijit, and all our good friends from Nasik, Praveen, Rathi, Jayanti Patel, Rajendra Shah, and I specifically remember Abhijit because when he referred to his father's name, because with whom I had worked long for almost 2 decades, or more than 2 decades. So when he called me and said that I'm so and so, I couldn't say no for the accepting the invitation to address virtually. I'll be happy to come physically as per your personal invitation. Definitely, it will be pleasure. But let's see when the situation arises, proper function arises. We'll definitely like to come to Nasik. And you are right, since it is almost a decade since when I've not come to Nasik for any professional work. I may have come personal work, but not for professional work. But definitely, it will be good to connect with all of you. And as I was just mentioning, now the younger generation has taken over, so I'll be happy to see younger generation and also meet my colleagues or counterparts who were there that time, who were practicing and still practicing. So I'll definitely be happy to come and meet all of you. Friends, I was saying that there's an advantage, disadvantage of physical versus virtual. Advantage of virtual is you're sitting here, you can address so many of you, connect with all of you virtually, and then you can at least without traveling for 1.5 days, you can be with all of you. Friends, we have tried to cover within whatever short possible time and what we could understand the intricacies of the finance bill, and particularly only the direct tax provisions. We have concentrated only on the direct tax provision, and we would not like to venture into economic aspects or any other aspects, because that's not our forte. Neither we have full knowledge about those provisions. So we have tried to concentrate on that, and I must thank my colleagues who have helped me to prepare this analysis, and short time they could roll out. That is Nikhil Tiwari, Pranay Gandhi, Rushabh Jalan, Palak Mehta, and Lake Mehta. So all of them helped me to just compile all the suggestions and select which are the right provisions which we could consider. Friends, those who had seen the finance minister presenting the budget yesterday, so we were wondering, because when she finished economic aspect, then she finished some of the other aspect, and then she came to direct tax provisions. It was only 6 to 7 minutes, literally 6 to 7 minutes, when she finished presentation on the direct tax. So we were very happy at that stage. It looks that at least our suggestion or recommendation for all these years, there should be 5-year no amendments to the Income Tax Act, and then that's the biggest relief, or biggest at least a benefit to the taxpayers. It is no tinkering of the tax laws every year, unless there is absolutely necessary, like COVID provisions or something like that, which we want to, because circumstances beyond the control. So that was short-lived, because after our budget presentation was over, then it was possible for us to download the bill, and we could find. And then to our surprise, there were 84 amendments in the direct tax bill. And again, 84, it is only the number. If you see the sub-clauses in which they have amended, that will definitely cross at least 200 amendments. So therefore, what we say, I do not know, jokingly we always say, finance ministers always know what is given to them in writing in the budget speech. They do not know what is a fine print. And they may not also be aware that there are 84 amendments running in 200, really the provisions which are getting affected. They also may not be aware, because bureaucracy to an extent always plays a mischief. Rightly, wrongly, I do not know. So they play the mischief and put through a lot of things within the lines. And this is what exactly has happened. So some new concepts are getting developed in the last few years. So earlier, it was retrospective amendment, was very, very normal, very common. And host of retrospective amendments we saw in 2012. Maximum number of retrospective amendments were made in that year. And starting with Vodafone Amendment, what we called Vodafone Amendment, which became world over famous or disfamous for India. That amendment was in 2012. But post that, there are several other amendments have been carried out. And it was a promise by the present government. And that time, Arun Jaitley ji, he has made a promise on the floor of the House that it is our government's desire not to make any retrospective amendment. So, and they partially were correct, partially not correct. And every year we have been seeing there are some amendments which are retrospective. So to get over that retrospective, and in fact, if you see Finance Minister's speech, last year's Finance Minister's speech, she was saying that we are quite averse to making a retrospective amendment. And therefore, the Vodafone Amendment, which was made in 2012, she's reversing that provisions. And she's withdrawing those amendments made in 2012. And she says it is our government's desire that there should be stable laws, and we do not want any uncertainties in the minds of taxpayers or investors in the country. But that again lived very shortly. And even the same budget, there were at least 15 or 20 amendments which were retroactive or retrospective in the nature, because there are transactions which were executed earlier were getting affected. That becomes a retrospective. And retroactive, as I mentioned, the provisions which are immediately made applicable, because if you see the finance bill gets passed in the month of April, May, whatever the date, generally 12th or 15th of May, that's the cutoff date, then they pass the finance bill. That time, the bill becomes act. So really, that is the time when it should have been any provision. So if the provisions are made which are immediately applicable from 1st of April 2021, that is for assessment year 22-23, then that will become a retroactive amendment. Though not retrospective, theoretically is retroactive. Retroactive because the transactions have already happened. Year has already passed on. And then you make amendment after the end of the year saying that no, this is what we want to do, and which is what is contrary to the promises made on the floor of the House. Not that all promises of floor of the House are honored, but this is one of them, at least for the direct taxes concerned. Another interesting aspect of this year's provision is the section 2 of the finance bill. If you see this carefully, it says all provisions are applicable from 1/4/22, that is assessment year 22-23, which means unless otherwise specified, this will be applicable immediately. So therefore, we have to literally find which are the provisions which are applicable for the really next year. That is the normally should happen is 23-24. So therefore, literally we have to scratch through and find out which are the provisions which are applicable next year, because most of the provisions which are so-called revenue generating provisions have been made with immediate effect, and which is the little cause of worry, which is what we say retroactive new concept which is started. The second interesting aspect is, and this is not something first time that has been brought in, but interesting to see what is their goal and achieving, what are the objectives they wanted to achieve in this year's finance bill. Rate of income tax, 100 marks, because there's no change made, and whatever changes made are on the positive side. So we give that full credit to that. Rates of taxes, there's no done. Promoting voluntary tax compliance and reducing litigation. We'll come to that whenever we are coming to the individual provisions, how far this is achieved. Socio-economic welfare measures. Yes, there are two economic measures. For handicapped person, one, and second is there is another is provision in respect of COVID expenses. These are the socio-economic welfare measures. I'm not sure whether there are any other socio-economic measures. Then widening and deepening of tax base. Yes, this has been very, very scrupulously, unscrupulously have been followed. Revenue mobilization again has been done. Phasing out of the exemptions has been done, and rationalization measures. And the rationalized measures, a lot of provisions have been made to say that for simplification, removal of doubt, a lot of things have been done, which will come to. So really dangerous provisions which are seen in the widening of, deepening of tax base, revenue mobilization, which is really has created little uncertainty in the market. Little uncertainty in the minds of the taxpayers, and which is what is creating little worry. Now, let's go to the positive side of the things, and what market didn't help. Market did help to react positively. So you must have seen the market yesterday going up to 950.9 point, then went down to whatever negative, then came back and settled at 500 points. Again, I was told the similar thing happened. The positive part of this budget is there is no change in the taxes or surcharge rates, except in 1 or 2 cases, which I will touch it a little later. So therefore, this is important aspect to be kept in mind, which gave a positive feeling to the taxpayers in general. Now, why I say taxpayers in general? Because a lot of people were expecting some changes in the dividend taxation, some changes in the long-term capital gains on shares, some changes in the period of holding of shares, which was 1 year, whether it be extended 2 years, 3 years to make it short-term, long-term. So all those were the rumors going on or news floating around. So therefore, people were apprehensive that something might come in that respect. Fortunately, not has been touched. The grapevine in Delhi, which a friend of ours in Delhi say, there has been high command. Earlier also used to be high command, now also is high command. High command had passed on the message to the finance ministry. No, nothing should be done which will harm their electioneering prospects in the 5 important states, including UP, because that's a gateway to the Delhi. So therefore, we can't afford to do anything which can disturb our prospects in UP. So therefore, you keep everything as tax friendly as possible and don't disturb the apple cart which is going on. So that is one of the reasons for this positive. Whatever it is, I'm happy that there are no changes made. That itself is a positive sign. No changes made. And we always say, finance minister should always consider what was said by VP Singh in 1985. There should be long-term fiscal policy, in which we have been representing from various forums, but somehow it has not reached to Delhi level, not appealed to them yet. There could be something long-term fiscal policy, but at least this year, no change in the rate of tax is a good measure. That's to be considered. I was referring to a beneficial provision, which is how has happened. As all of us are aware, there was hue and cry as to the rate of taxes because of for individual high net worth individuals was going up to almost 43% because of the 37% surcharge, what we call super rich surcharge, which was raised at about 37%. And that was creating a lot of at least difficulties to the high net worth. That was not helping people to save much amount, and people were thinking of settling abroad. And there are many people, HNIs, have left country and gone and settled abroad, which has gone, a lot of capital has flown from India to those countries. So I think that's the sign which they got it. So therefore, what they did was last year, dividend, the surcharge on the income, tax on the surcharge on the income relating to dividend and long-term capital gain on equity shares of a listed company were capped at 15%. So to that extent, it was a beneficial measure, but then they created disparity, which is what was brought to the notice. Why only disparity in respect of capital gains on equity shares of a listed company? Then now they have realized that it should be given to all long-term capital gains. So now that has been extended. So surcharge on the income relating to long-term capital gain will be at maximum at 15%. It will not be at a higher rate. So therefore that is important provision. So the rate of tax, which was going to up to 43%, will come down to almost over 37%. Is again, I think, important and welcome measure, and we should welcome that. So I think that's a good sign, and that we should welcome. But what was really appealed to the ministry was the 43% is too high a rate of tax. We must cap it not more than 36 to 37%. So therefore, don't go, in fact, 34 to 35% should not go to 43%. But that's a disincentive for people to really earn and invest. So because that was really the point which was not really considered. And but that has not been accepted for that. So that's the positive side of it. Third, COVID relief measures. I think that's again important provision, and we need to keep in mind what is the changes made earlier and now what is legislated now. I think that's an important point to be considered. The first is, as you are aware, what was done earlier. It was a demand from everybody that COVID reliefs have been provided by corporates, various other associations to the COVID affected people. And in spite of that, nothing was done. It took almost a year for government to realize that they must come out with some relief package. Finally, they came out with the relief package, and the relief package was announced by a press release on 25th June 2021. So again, as usual, any relief package or something is never given wholeheartedly. So therefore, some provisions were left out, not considered, not detailed out properly. So fortunately now, as it looks prima facie, that this is covered for the employees, their family members, if they receive something from their own companies. Secondly, for any other associations or any other people, for individuals, for medical treatment in respect of COVID-related illness, that is also excluded. Then spouse, children, depending siblings of the person, COVID-related illness from employer or any other person, that has been also excluded under section 56. For the third persons, it was restricted to 10 lakhs rupees. That's fine. I think that should be perfectly all right. But therefore, this is now regularizing or legislating the press release, which was issued on 25th June with modifications which were asked for. I think that's an important change that we should keep in mind. Then other few important provisions which are brought in, I think we should keep in mind, again, good provisions. Higher deduction for ATCC, that NPS, what we call it, what was restricted to only central government employees, increased from 10% to 14%. Now that is realized that they have to extend it to state government employees also. That's welcome measure. Second was again deduction under ETDD. Again, it was very, very restrictive, and it gave a relief to only certain categories of people in respect of benefit received by disabled, by of annuity or any lump sum amount received. But again, there were lots of restrictions, but that restrictions are sought to be further liberalized and now has been brought in. I'm not sure whether it fully takes care of all the hardships with the parents of disabled people who are dependent on them. Everything is gets, because even that magnanimity is not shown by the finance ministry or CBDT. Because people who are already suffering, don't penalize them or don't tax them for the certain incentives or benefit what they're getting from medical or insurance or anything. But that anyway, that's what is the situation. Step by step, it has been getting corrected, and that will happen. Now then there are certain now they have put phasing out of exemptions, what we are talking about. So now this is one of the phasing out, because there were lots of exemptions which are again theoretical exemptions for at least people like us. We are not getting affected. It was because of the projects which are executed between Government of India and foreign agencies, with various subsections that has been now tried to be phased out, and that will not be available. So that again, not much of a relevance for all of us, but that is how to complete the this. Now, these three more important amendments which are being carried out, two more important favorable amendments which are carried out, which need to be kept in mind. Now, first one is, as you are aware, incentive provision has been brought in, that those companies which start new companies, new companies which are formed and which starts production before 31st of March 23, they are entitled to manufacturing companies were entitled to 15% tax reduction, the tax rate, provided they do not avail any other tax exemptions, deductions which are listed out in that section, which is popularly known as 115BAB companies. So those companies, because we have a number of different rates, 33%, 25%, 22%, and then 15%. So this is the various categories. And one of the most complex provisions are in the rates applicable to individuals as well as corporate, because every time you have to look to the which company we are talking about, which rate we are talking about, and then find out what is the tax payable by you. So I think that's a critical, as we have seen that even individual cases, there are different categories, different sources of income, and then you have to find out what is the rate of tax, what is the surcharge rate, where is capped or not capped, and then find out what is the rate applicable. So therefore, that's a I think that gives a work to productive, unproductive, I do not know, but that given work to us, all of us, to do all this, and that's what we are doing. And same is the case of companies, various rates of applicable. But what is the benefit? They have to start production, manufacturing a production by 31st March 23, which they have realized that because of the COVID and so many other restrictions, fall in demand, fall in getting approvals, installations, everything. So that fortunately they agreed to extend the date to 31st of March 24. So those companies which have been already started but couldn't start production so far, and they want to avail this benefit of 15%, I think this is a good provision. And because of 24 is sufficiently large, I think almost 2 years and 2 months almost extension they get. So therefore, that could be considered as a beneficial provision, and we could be useful to them. The next is again extension of profit exemption to startups. Again, as you are aware, a lot of startups have started in the country, but all these cases, startup companies have to be set up before a particular date. That is, date was 31st March 2022. So now that they have realized that there is a lot of demand, a lot of requests from startups. So therefore, that date of registration of these companies, startup companies, has been extended to 31st March 23. So again, see the difference in the wording. In case of manufacturing companies, the date of starting of production, companies had to be formed earlier. And here, this is incorporation of the companies should be done before 31st March, and then they get the benefit of certain number of years after starting of commercial production. So that's each case we have to be careful and see what is the difference of the wording. The next important provision, which is again may or may not be applicable to many taxpayers, but important provision, is a few years back, if you remember, Government of India realized that there are a lot of our Indian companies who are holding subsidiaries abroad, or holding large shareholding abroad, are not declaring dividend because the rate of tax is quite high in India, and which virtually it gets the higher rate of taxation because that income gets taxed in host country, Again, when the dividend is received, they get taxed at again higher rate here. So therefore, government said, we will give you concession. Bring your whatever money, whatever dividend, whatever money the company has earned by dividend, bring it back to India. And with that objective, that 15% was 15% was a concessional rate of tax was levied, and therefore it was continued to happen. But now that has been cut down. They said, no, this is last year, we will not give you anything more. So that is removed from the next year. So this year will be the last year in which they will be getting this benefit. Next year, they will not get a benefit of this provision. Now the important provisions is corporate tax and deepening tax base, which comes under that category. I think that's important for us to have a look at it. So interesting to see is what are the provisions which are brought in and what is the implications of this, which is what we are saying, why is bureaucratic budget, which is a classic case which we need to consider. Now, those, I think most of us are affected, most of our clients are affected by this provision, is in respect of expenditure incurred for earning of an income which is not taxable in the Income Tax Act, and for which few years back if the first provision came in under section 14A, then the rule 8D came in, which was modified from time to time, and again major change was made in the earlier years, and again it was made amendment to that section also, section and rules also. But the fundamental principle is there has to be earning of exempt income, and there should be some expenditure incurred for earning of that exempt income. So the courts had taken a view to attract the provisions of 14A. You can't straight go to the rules. First, you have to apply the act. Once you come to the act and come to the provision, and as per this provision, it comes to the knowledge that this provision is applicable to you, and you have some exempt income during the year, then expenditure related to that income, earning of exempt income, will be disallowed to you. Now, this is the interpretation, which is, according to me, is the correct interpretation of the law. And therefore, Delhi High Court, Special Bench of Tribunal, in several cases, had taken that view. And according to that, that view was being accepted by most of the forums. Now, as usual, whenever there is some incentive given, government doesn't like those provisions, and then they feel, no, this was never our intention. Now, what is not intention? They want to say that rule, that is 8D, should supersede the main section. That is not our intention, that even if you don't have exempt income, then you can't see anything. So therefore, this is the classic case of supervisory or authorities, that is rule-making authority overriding the legislation. This is what exactly is what is happening in this provision. Now, what amendment says, disallowance will be carried out irrespective of whether you have exempt income or not exempt income during that year. Now, take a case. There is a holding company in your group. That holding company is holding in your in the operating or manufacturing companies in the company, and that manufacturing company has not declared any dividend. So there is no income in the hands of holding company. As per this High Court decision was, if you are not received any income, there cannot be any disallowance under section 14A because there is no income received by you. What will you disallow it? Because by making a disallowance, you are unnecessarily penalizing him. But now, as per this provision, if you have investment in the subsidiary company, which is manufacturing company, even though dividend is not declared, there will be two-way disallowance. One is for your capital investment. If there are any borrowed funds, there will be disallowance. Plus notional expenditure will get allocated over this investment. And that notional expenditure, both the notional disallowance will be made in this case under section 14. And that also becomes quite severe in case of partnership forms, wherever there is a share of profit received, because the decisions were saying, if you are not received any income during the year, which is exempt from tax, then there is no question of disallowance under 14A. Because many times partners borrow and pay interest on their own or carry out an expenditure for earning of that income, and which they don't get salary or interest. In that case, they only get share of profit. In that case, this provision gets triggered, and it will now be quite severe. In fact, we had succeeded in few cases when there was a loss and not income. these provisions can't be triggered into 14 days. And that was on the same principle. But now all this principle will now be held against, and will be interesting to see what is it done. Another interesting provision, again, very, I somehow appreciated this year's the explanatory memorandum for provisions for deepening of tax base. Very interesting. Those who are interested in understanding the philosophy, you should read this explanatory memorandums. I wonder whether it is some submissions made before the tax authorities, or is a submission made before tribunal. This is the format in which this explanatory memorandums have been given, including, and what is the starting point for this? Some tribunal has taken a view in favor of the department. Therefore, we want to make this amendment. They say the tribunal has distinguished High Court decision. They have distinguished the circular of the department. Therefore, we want to make this amendment. Now, this is not what is explanatory memorandum is sought to be covered. This is not your justification for making certain amendment or justification for this. There may be your background material, but not the explanatory memorandum. And this is a classic case of this year. Some of the, wherever there is a deepening of tax base or tax avoidance measures have been considered as a not in their interest, that has been done. And this is classic provision of what we call it freebies to doctors, what is popularly known as freebies to doctors. And the interesting part, sorry that there is a written as 23-24, it is effective from assessment year 22-23. That typo error is there, so that may correct it in your slides. So that or your printouts whenever you do, please make that correction. So now interesting part, what is this trigger point? Now you will find that payments were made to the doctors by the pharma companies, either for the conferences or attending the what we call it CMEs, monthly, weekly conferences, monthly conferences, wherein the pharmaceutical companies put their stall and the expenditure incurred by the association are reimbursed by the association. That could be one of the ways. There could be some brand reminders were given to the doctors so that it is their product is in their mind. So therefore, that's called brand reminder expenditure. Then sometimes there are gifts given to the doctors in the form of, say, stethoscope or weighing machine or whatever, maybe a laptop or something like that, on which your product material or anything has been there. Then there are overseas conferences held where some of the doctors are deputed or requested to go and attend that conference for them to know the international inventions in the product line in which, or the products in which the pharma company is working. And that many times happens regularly. So question was, all this benefit or are to be treated as freebies or not taken as freebies. I'm not talking about extreme cases, because I am also aware of the extreme cases and misuse happened in that. And some of the doctors, the way they get the samples and the doctors sell the samples. So all those extreme cases I'm not referring to, but where the samples, because as you are aware, pharma companies are not allowed to sell their products, not allowed to advertise their products. So what is the way they can communicate their production? They can give the samples, tell the doctors, by way of conferences, they can go and do the various workshops for the patients to find out the what is happening around. So they take that all workshops and everything, and then they communicate to the people, or they carry out the camps to find out which area has a heavy diabetes, which of the area in the country had high diabetes, what is the medicines could be useful to them. They may not be doing anything of propagating their product, but they are helping in the form of different type of CSR. You'll find many programs, which is the TV or other media, wherein there is the advice is given on various issues are discussed, and then the doctors give the advice. Experts who are there on the panel give the advice. No, this is to be done. This should not be done. So that is all this there. So all these programs account to me in the different form of a CSR, except as I again qualify myself, to the extent of extreme situations where the coins were gifted or gift cards were gifted. So all those cases I'm not referring to. Or where the spouses of the doctors were allowed, with children were allowed to go for holidays, and that expenses were input. That cases, even I think we should not encourage. Neither we support. We as a professional should not support. But there were genuine expenditure which was incurred by pharma companies, like sales campaign, educating the doctors about the innovations world over. if that is done, whether those expenditures should be allowed or not allowed. So first time circular came from what we call it Mci Circular. There is Medical Council of India had issued a circular saying that certain expenditure is not to be allowed. But the circular was restricted to saying what doctors should not accept the incentive or benefit from the pharma companies. That was a restriction or their code of conduct on the doctors. But that they had no authority to put the restrictions on the pharma companies. And then there were several interactions, meetings with the Pharmaceutical Association. Everywhere they clarified, no, this is not meant to be for you. It is meant to be for the other people, only doctors. So 2009 to 12, nothing happened. Again, 2012, government realized there is no circular from the CBDT. So they issued a circular in 2012 saying that no, what we are saying in by MCI is also applicable to under Income Tax Act, because that's under ethics or code of conduct of doctors, but we want that to be expenditure to be disallowed. So that for that provision by circular, department started disallowing all those expenditures. Matter came up before the first the public interest litigation before Himachal Pradesh High Court, which this is all you will find in the explanatory memorandum. I am not sharing any secret about this. This is because I'm professionally I do argue such cases, but you will find this everything in the explanatory memorandum. It went to first Himachal Pradesh High Court. They upheld the right of the government to put some restrictions on the doctors in freebies like this. So that was being done. That again went before Delhi High Court, and Delhi High Court in Max Hospital said no, that circular neither 9 or 12 can be applied to the doctors. That can apply only to doctors and not to pharma companies. And based on that, there are few High Court decisions and also several tribunals have taken a view that no, it cannot be applicable to the pharma companies. So whatever expenditure incurred, which are genuinely business expenditure and not something like I was talking about gift coins or expenditure of the family members of doctors and everything, or that type of expenditure, if expenditure could be justified as a business expenditure, it is allowable as expenditure. So it was so far so good, it was going on. The Bombay, one case, the Honorable Tribunal felt that no, these decisions are too much in the favor. So therefore, what we need to do is, we need to form a larger bench of the special bench. That's called special bench should be formed. So therefore, they made out the case saying that we want to form the larger bench of the constitution, and they referred the matter to the president to take a decision. Now, president has not given a consent to form the special bench. Keep that in mind, which doesn't come out in your explanatory memorandum. President has said that no, I'm not giving any permission just now, where there are enough number of precedences. Not that any order is passed for or against. And till today, all the courts are taking a favorable, all the tribunals are taking a favorable view that no, their guidelines cannot override the pharma companies. So that was going on. So keeping that in mind, the reference made or what is mentioned in that reference to the president, that becomes a basis for making this amendment. So interesting too is, this is really should not have been public. This is the internal correspondence between the division bench and the president that became public document, and that document becomes a basis for amendment in the Income Tax Act. And which is what I am saying, how bureaucracy gets into the bigger shoes and not understanding the implications, logic, philosophy, nothing is applicable. They just made this amendment. Now, interesting amendment, you must see the amendment and see the implications, and very, very far-reaching implications. As I said, fortunately, this is not a retrospective amendment. This is applicable from 1/4/21. So this entire year's expenditure will get hit under this provision, but not our earlier years. Again, that is a matter of debate and going to be a litigation up to Supreme Court as to, because words used are for removal of doubts. Again, they are very, very good on this wording. For removal of doubts, it has always been our intention to treat that the expenditure on this is not allowable from outside. And what have they provided? Payments for any offenses or any prohibited acts under any law in India or outside of India. Now keep this in mind. Outside of India, laws or defaults committed by any of the pharma companies or anybody claiming expenditure outside of India will also get hit by this. I will tell you about this, why payments are offenses or prohibited acts. Suppose there is some pharma company is having a pharma company, need not be pharma company, anybody can be any company. Some fight is going on. Suppose you have a branch outside of India, there is some litigation going on that, and you incur some expenditure, and the authority doesn't accept your contention, and therefore there is some penalty levied on you. So that will be treated as prohibited act, which the court in that country has held against you. So therefore that payment made by you will not be allowed to you in India. Now, how far your stretch can be there for this is one classic example. Second classic example, benefit or perquisite provided to any person in violation of any law, rule or regulation or guidelines governing conduct of such person, amendment brought to disallow claim of freebies or paid or provided to doctors with immediate effect. So see the wording, law, rule, regulation or guidelines. So that covers everything possible, including MCI guidelines. And that is applicable to the governing the conduct of such person. So that means doctors is applicable. So therefore that will also get applicable, and that will get disallowed. So any expenditure incurred. So again, that will be a huge litigation, whether the particular expenditure has created any benefit or perquisite to the person in violation of law. Now, brand reminders I have sent to the doctor. Will it be a benefit or perquisite to him? That's the question. There will be several other expenditures. Like camps are held for the patient, detection of patients or detection of diseases in the particular area. Will it be a benefit because payment is owed to doctor to conduct that camps? Will it be applicable or no? Expenditure is incurred to conduct the CMIs, that weekly doctors meeting or anything which is sponsored by association and which is expenditure is reimbursed by the pharma companies. Will it be applicable? So therefore, all those will be now matter of litigation. As I was saying, it is at least it will go up to the Supreme Court to resolve this issue, and fresh set of litigation will start. And third is again compounding charges paid under the laws in and outside of India. If there is any compounding happens anywhere for any so-called default or any litigation, I can give you the one classic example. It not necessarily this is applicable to pharma companies, it will apply to everybody. If you see the real estate companies, every real estate company's construction rules, there will be always compounding charges because they will keep constructing till you get the approval. And when the approval is received, they pay the compounding fees and continue their construction. Because you don't get the approvals when you want that, because the particular floor area, that there are several technical issues which are there in the real estate industry. So all those compounding fees will now get hit by there. If you remember, we always had the decision of Mahalakshmi Mills case, which is difference between the penalty and the compounding fees, or which is the compensatory fees. So all those cases now will get hit, and whether it will be called compounding fee, not compounding fee, what will happen? Again, host of litigations will start on this matter. So therefore, I can only say they have created an avenue for the professional like us to litigate for the taxpayers for at least, I would say, minimum 10 years time. So this is a fresh set of litigation. So far, we are litigating that this is not the expenditure which is disallowable. Now we'll have to defend that this expenditure is not falling in this clause. So therefore, this is going to be interesting part. Another interesting simultaneous provision which is made is if you provide any benefit or perquisite to a resident carrying on any business or profession, then you have to deduct tax. And if there is any non-monetary benefit perquisite, or where monetary component is not sufficient to recover the TDS liability, the person responsible for providing such shall be ensure that tax has been paid before such benefit or perquisite are released. Threshold is 20,000, leave apart the threshold. So therefore, any benefit or perquisite given to anybody in your customer, or anybody, distributor, anybody, did not be pharma industry. If there is something benefit or dealers conference is held, this, whether it could be treated as a benefit or perquisite, in that case, that cost of their staying in the hotel, cost of conference, their meals, everything will, travel arrangements, what is made, or entertainment programs are in, all this will come under the non-monetary benefit or perquisite received by them, and therefore they will be liable for the disallowed first perquisite in their hands, and plus the amount will be disallowed under the earlier provisions of the Act. So therefore, this is very interesting provision, which is this is called typical bureaucratic mind, how it functions and how amendments are made to consider. Always, whenever we interact with right from finance minister to everybody, I said, we only follow foreign countries for some good, some certain practices or certain rules and regulations. But there is a fundamental rule in the foreign country that if you are making any amendment in the law, cost benefit analysis has to be done and enough time has to be given for the taxpayer and the tax administration to implement that law. Just latest example I will give you, refer the Uae Tax Provisions which have been brought in about 3 days back. What it says is, we will tax the income of the corporates if that is certain threshold of some 3,45,000 dirhams or some amount is prescribed at the rate of 9%, but that provision will be applicable after 2 years. Keep in mind 2 years, that means breathing period of 2 years has been given for them to everybody to organize their affairs and decide what is to be done. So that's the way best practices is there. UK, there is a best practices. I'm giving a UK example because we are all familiar with the UK system. UK also there is any provision. Government of UK has to first make that policy public, make that public debate, get the decisions, get the views of the cost benefit analysis, and then decide whether to implement or not implement that provision. But in our country, that never happens. Most of the amendments now, little sarcastics about it. If we find out any deficiencies in any of these provisions, point out to them in the ministry, all will get rectified before it gets passed, and then it will become far more severe than what it was in the original bill form. And last 3 years' time, you will see several provisions have been made only at the time of passing a bill, which never been part of discussion, never been part of this, which is the little disturbing trend, and which is growing every year. And this is a classic case of that. Another two interesting provisions, which we really feel irritated with the certain provisions, and these are the two other provisions, like that one was at least prospective. Now these two provisions, look at the provisions way it has been brought in. Look at the first provision. At least many of you are familiar, at least particularly corporates were claiming the education cess on surcharge, education cess the tax, which is about 4%, 2%, then went to additional 1%, then became 4%. 4% surcharge, education cess on the income tax was claimed as a business expenditure. Logic behind it was, there was a circular of the department, CBDT, on 18/5/67. Note the words, 18/5/1967. There is a debate in the parliament, and parliament after debate, tax, levies or cess was the wording for disallowance under 40A, and cess was removed in the discussion. And that is clarified in the circular of CBDT, saying that no cess we do not want to disallow, and only tax and tax only has to be, tax and levies has to be there, but not the cess. Now that continued for several years. The issue came up again first before Rajasthan High Court, and Rajasthan High Court said, after dealing with every possible argument, said that no, this is not the cess, or cess is not covered in the tax or levies, and therefore it cannot be disallowed under 40A, because only what can be disallowed is only tax or levies leviable under the Income Tax Act. Though this cess is leviable through Income Tax Act, does not mean it is a tax disallowable under 40A. That decision went on. Then the Bombay High Court followed. Then there are several other tribunals and High Court followed, and the decision was more or less accepted by everybody. Now look at the audacity of this, our finance ministry, or I call it CBDT, is really not finance ministry has to understand any of this. They write all this. They say, no, but this is not our intention. Yes, we issued circular in CBDT. Parliament debate also, we are aware of it, but we are not agreeable to that view now. And therefore, we want to make a retrospective amendment from 1st of April 2005. Look at this audacity of the so-called lawmakers. And look at the quantum involved. Now, what is it says? Says is 4% of the tax payable. 4%. Now 4% of the tax payable is claimed as a deduction in business expenditure. So if we calculate average rate of tax by corporates or by individuals, everything, say about 20%, who are claiming this as a business expenditure. Again, it's not applicable to everybody. It is only where profits and gains of business or profession. Only those expenditure will be claimed as 4% of the tax surcharge, education sales, which is claimed as business expenditure. So at 20%, so 20% of 4%, which is 0.8%, and look at how much will be the quantum involved in the whole of the country or whole of the tax, and they want to make it retrospective. Now look at the situation, look at the mindset of the people. What do we call this mindset? Now, if you have given a circular, you have not withdrawn the circular till today, and suddenly you say that no, I don't agree to that circular, I don't agree to Bombay High Court decision, I don't agree to Rajasthan High Court decision, because Bombay High Court has not considered some Supreme Court decisions observation. Now, who are you to challenge Bombay High Court? You go to Supreme Court, challenge it there. And if you want to do any amendment that is not there, do it from next, that is assessment year 23-24, which is a prospective proper arrangement. First, you withdraw circular, defend yourself in the Supreme Court, and simultaneously do the prospective amendment. How can you do retrospective amendment for such a petty amount? Pettiness of mind is really shown from this amendment and making it retrospective. That is a pettiness. If you don't agree, fine, make it prospective, and then that is fine. So therefore, this is a mindset which really troubles us, and how unproductive litigation is going to go on, and how unproductive minds of people gets created for several other unproductive work and several discussions we keep doing with the various forums at this type of amendment. This is an interesting amendment. Under deepening tax base, this comes under deepening tax base. Now, another interesting aspect is donation given to scientific research associations. I'm not sure how many of you are familiar with this litigation. Government encourage for scientific research to be carried out. In fact, if you see yesterday's finance minister's speech, she says we want to encourage private R&D carried out by private associations, and 25% of the government grant will be reserved for research carried out in by private associations and not by government association, like whatever the Defense Research Association. 25%. No, look at the amount, whatever amount it is. Now, what it says is, if you contribute to the research association, university, college, and it will be allowed to you as a deduction, association has to be recognized by the DSIR and ministry, finance ministry. Unless that is allowed to you, you are not entitled for any deduction. So that is a precondition to get the deduction. Now, the next important point which is to be kept in mind is, this deduction was, suppose the exemption granted to the association is withdrawn because that is carrying out any fraudulent activity or doing anything else, except let's assume that there is a fraudulent trust and that is mismanaged, fraud is carried out, everything is possible. Then what happens is that exemption is withdrawn maybe from that year or earlier year. But there is an amendment made in the Income Tax Act after Supreme Court decision. Keep in mind, Supreme Court decision says that you cannot withdraw it retrospectively because the person who is donating has no control over the association. What can he do if there is any fraud and you are not withdrawn certificate? How can he say that if you made public, yes, this is a donation is bogus, this association is bogus, therefore donation will not be allowed. From that date onwards is fine. But how can you penalize somebody as given on 2 days, 2 years, 3 years, 4 years earlier? There is a Bombay High Court decision which is upheld by the Supreme Court. Post that Supreme Court decision, there is an amendment made in the Income Tax Act which says that this deduction, if you have made a donation to the trust which is recognized by the DSIR and government authorities, then deduction will not be withdrawn retrospectively. If you withdraw from particular date, it will be only prospective, not retrospective. Now look at the amendment. Now they have put a restriction or the obligation on the associations to file the statement of donations received. Fine, that's absolutely fine. There's no doubt about it. Now what it says is, if such association does not file the statement with the government, then deduction grant, the donation given to you will not be allowed to you. Now, what is the control you have? if the act itself permits you, even if your recognition is withdrawn, still donation given is not withdrawn. But for non-filing of application or not filing of statement, how can you withdraw the deduction given to you or donation given to you? This is a classic case of typical bureaucratic mind sitting at the North Block ivory tower. This is exactly what irritates people and all of us like this. You make this type of amendments to what do we achieve out of this whole purpose? If your machinery is geared up, please catch hold of those people who are not performing, penalize them, prosecute them. But why people who are genuinely recognized by you, I give a donation and you want to withdraw my donation deduction for that? Why? Because they have not filed some particular form, which is one or two more provisions. I'll come to the provision a little later. But this is a classic case of meanness of mind of the bureaucracy sitting at the ivory tower there in the North Block. Then one or two important provisions before we go to the 2 or 3 other interesting provisions what we discussed just now and how they are tried to supersede some of the Supreme Court decisions in these provisions. One is strategic investment like Air India and the strategic investment they are at least hoping to do. In that case, they say 51% so long as there is no change in the shareholding, losses will be allowed to continue. That is 79 private, that is extended to this PSU divestment also. That's fine. That's welcome provision. Now, interesting provision is come under 43B. As you are aware, there have been several decisions, several years, including circular of the CBDT, that when suppose interest is not paid, but allowed to be accumulated, and that becomes a funding of that interest payable, that will be deemed to have been paid by you. It was under 43B, sales tax schemes and everything it was there. Even in interest it was there. So the view was taken that if you are accumulating the liability and converting into debentures, liability to pay interest to convert debentures, it is a deemed payment as per their old circular. Because circular was under 43B for the sales tax and other liabilities. And this has been used for the all other debentures and other loans also. Now they said, no, that is not acceptable to us. It has to be only actual payment. Only actual payment will be allowed. So again, that has been made changes. Interesting provision, which I was referring to, is in case of a non-existent assessment on non-existent entity. Now, interesting part is that nothing is appearing in the explanatory memorandum. But if you want to learn this, why this provision has been brought in, I will explain the facts of that case and what is likely to happen of this provision. I have not still understood whether that will override, supersede the Supreme Court decision. But the provision, I'll explain the law first and then the provision. Now, let's see the first provision. What was the decision was? Suppose one entity of so-and-so subsidiary of Maruti got merged in the Maruti. That intimation of the merger has been given to the income tax department. So that subsidiary company or entity which is merged with Maruti is no more in existence. The law says that once intimation is given and that order is passed of amalgamation or merger, then that entity is no more in existence. So that is as good as non-existent entity. So therefore, tomorrow assessing officer passes the order instead of the successor entity on the non-existent entity, then that is bad in law, which is what Supreme Court said, it is bad in law. Because you need to be aware if intimation is given to you and you are still making assessment out of the old entity and making a demand on that old entity to pay the taxes, that order is nullity in the eyes of law, therefore not liable. So this is what Supreme Court said. Now they said, no, that is not acceptable to us. If during the pendency of all these proceedings or what is happening around, even if order is passed in earlier entity, still it will be deemed to be validated. Provision of 170(2)(a) is there. Wording of the section is quite bad. According to me, it will again lead to several litigations. But intention is to disallow, to make this regularization of such tax orders passed on non-existent entity. So therefore, this is the interesting part. Again, how they are trying to bypass or supersede the well-established or Supreme Court decision which they don't like to be looked into. Right, wrong, fine. But how can you make such laws to supersede certain decisions? Next is, I would say, is a good provision. But what it says is that whenever there is a entity merged with another entity, and that after the entity is merged, within the accounts get amalgamated after the amalgamation order is passed or effective date or appointed date of order is passed. So really from that date onwards, that both entities become together, and then losses carry forward, whatever happens, that becomes a part of that new entity. The many times what happens, these entities are appointed date is of an earlier date and not a current date. Suppose let's say that amalgamation is effective today, but its appointed date is 1 year before. So as per the Companies Act provision, this gets amalgamated from the earlier date, and therefore, which is there is Supreme Court decision which has been accepted. If it is that date, question is from what date, within what date you have to file the application for the revised return. And the matter went up to the Supreme Court. The Supreme Court in Dalmia's case has said, no, this is possible to be considered, and therefore you need not you can file the revised return. Need not be from the first date, but you can do the revised return from the date of order being passed. But now they have put it at the time limit of 6 months. According to me, the time limit of 6 months is quite low, and there are many times people who might not be able to comply with. They should have kept sufficiently long, at least 12 months time. But anyway, something has come. Regularization, person doesn't have to go to fight out to the court or Supreme Court to get this regularized. So therefore, that has been there. One more, two more interesting amendments, and again how they are trying to enlarge the scope or deepening the tax base is the classic. These cases, two amendments are interesting to keep in mind. First provision, as all of us are aware, Sophia Finance case, which is a very well-known case of the Supreme Court, and Supreme Court upholding the earlier decision or reiterating earlier decisions to say, you can ask the lender to prove the source of his loan, but you can't ask him to prove source of source. And these are historical decisions which is reiterated time and again. Then the issue came up about share application money, whether share application money also 68 will apply. And the Sophia Finance said, no, it will not apply. You can't ask the shareholder, company to prove the source of a shareholder. And Supreme Court said, no, you can't ask for it. So long as if you have anything to be done, you go and do as far as the shareholder is concerned. You can't go and ask company to establish the source of source. And you can't invoke 68 against this. This was amendment. Then to overcome that decision, amendment was made in 2012. So only that came in only for the purpose of share application money in case of unlisted companies. Again, note these words, it was only for unlisted companies, the share application money, and then source of source was to be explained by the company. Thereafter, now they want to extend the scope to even the loans taken by or cash credits of the taken by the assessee will have to be established by him, and source of source also will have to be established by him. So now that whatever superseding of the Supreme Court decision, right from which is standing for last 50 years, and Sophia Finance for last 15 years, has been now sought to be overruled by this amendment. But fortunately, not retrospective. This is a prospective amendment. Rightly so, they have excluded venture capital fund, venture capital companies. Rightly so, because that's impossible for them to keep track, because they can't be called really the assessees who will have control over the sources of funds of investors. So that has been done. Another important point, and which is going to be a troublesome to many cases, is Section 79A introduced to prohibit setting up of losses and unabsorbed depreciation against the income assessed as a result of search, requisition of survey, requisition or survey action. Keep that in mind. Very, very careful. Read the provisions carefully. Now, so far, what was happening was, even though income was assessed under the search seizure action, if you had a losses, either from business or carry forward losses or some deficit, it was allowed to be set up and only net income was getting taxed. Now that is sought to be revised, and it is from immediate effect. That is for current year also it will become applicable. That is from any period starting from 1/4/21. So this is another two risky provisions and quite dangerous provisions which you'll have to keep in mind for this year. Now this is, I would say, to a certain extent good provision, but the way it is drafted and which is likely to create some litigation and but this is as good as permanent VSV scheme which has been brought in the statute. Let's step back and see what was the provisions. If you have filed a return and you notice some mistake in your return, you are allowed to rectify your returns within a certain period of time, say 1 year or whatever the period which is prescribed there. In that case, there was no penal action taken against you. No, you have to only pay tax, but you don't have to pay any additional tax. Now they want to legalize certain things. What is the legalization done? Sorry, I made a mistake. Sorry, I'll come to that provision a little later. Sorry, I missed this provision. So I'll go to that provision since I've started that provision, which is next provision, and then come back to the earlier provision of cryptocurrency. So this is the updated of what they call it, updated, not revision now. No more revision, is updated return. What it says is, any person can furnish a updated return or income of other person in respect of who is assessable with effect from 1st April 22. That is prospective provision, which is rightly so. And applicable even if original return, belated return, or revised return not filed in the 11th year. This is important aspect, and I think that to the extent this is a welcome provision. If you have filed a return and if you want to revise, you can do the revision. Even if you are not filed the return, you can go for the first time and file the return beyond the date, but it is at a certain cost. And what are the cost, we'll just see a little later. And that is provision has been made applicable. So I say this is a permanent scheme available for anybody who has committed default or mistake. And what is it prohibited is only in following cases. Updated return of loss can't be filed. Updated return cannot be filed when there is a decrease in the tax liability. If there is search seizure proceedings applicable to assessee in the year of search or 2 preceding years, you can't file these returns. And then there are survey proceedings and everything 2 years prior to that, all those that has been there. You cannot revise the revised return. That updated return you can't revise. Then if there is any reassessment or revision proceedings pending or completed, again you can't go for it. And then there is again they have kept a power. A certain class of board will have certain right to say that this will not be permissible to file the updated returns. Then something else has been added, which says situation when updated returns cannot be filed. One is when there is a following communication prior to the filing of updated return has come from assessing officer under the Money Laundering, Black Money Act, or Prohibition of Benami Property Act, or Smugglers Foreign Exchange Manipulators Act. All these cases, they will not be able to file this belated return. Then if there is any information, exchange of information from foreign governments, if it is received and communicated before filing of the return, then such person cannot do. Or if the prosecution proceedings have not been initiated, prosecuting proceedings have been initiated. So all this class of people will not be able to file this updated return, but subject to that, all other people can file this so-called updated return, which we popularly call it a revision of return. What is the cost for paying this? Is cost for paying this tax, interest, and fees plus additional tax. What is additional tax? If you revise within the 12 months from the end of the relevant assessment year, then 25% of tax, interest, surcharge and cess, plus interest if it is payable under 234 ABC, which is there because of this additional income, that will be payable by you. If it is within the period of beyond 12 months but before 24 months, then it is 50%, not 25%. So additional tax, but all other charges will continue. Interest and everything will continue, and that will be additional tax. So I would say yes, welcome provision, but too many restrictive provisions have been made. So we'll have to see how to deal with that. Friends, sorry, I missed one provision, which is an interesting provision, which is too much. It was too much in the news as to what will happen with cryptocurrency, whether it will be legalized, not legalized, what will be the tax liability. So finally, without waiting for RBI, because RBI is taking its own time, as per them, is taking own time to declare whether they want to regularize this cryptocurrency or not cryptocurrency. So now they have refined the wording. It doesn't say cryptocurrency. It says virtual digital assets. And virtual digital assets, if you transfer and make any gain, then that gain will be taxable at a flat 30% without any deduction, without allowing any expenditure. That's a flat 30%. There are other ways. No loss can be set off. If you have made any loss in that transaction, you can't set it off against anything else. You can't set off any loss in any other business against the gain of this transfer. And that means it is a flat 30% tax on this cryptocurrency gain. Then it is also said that if that is gifted, this cryptocurrency is gifted to somebody, it is going to be taxable under section 56 in the hands of recipient. Like any other 56(2)(10) provisions, this will also be taxable and will be taxable at a market value as on that day. So therefore, that has to be kept in mind. They have also started from 1st July 22, Tds provision on this amount of the entire consideration. Now, I am still failed to understand, at least I tried to talk to a few people and find out how will this provision work, how will they recover these taxes, how will the TDS be done, who will do this TDS? Payments and transactions happen out of India. Payment has gone, suppose, from India. Will the banker come to know what is the gain, or what is the mechanism will be developed for purpose of determining this 1% deduction, 1% collection to be made, or TDS is to be made? I do not know. But we are used to this type of provisions. We make announcement and then find out what the procedure to be followed, which will come to when we come to faceless assessment. I'll share my thoughts on the faceless, how this has happened, how it became an senseless assessment. So we'll come to that provision a little later. But this is exactly what has happened. Now they don't know what the provision is, but they have got the provision. And if you have read the yesterday's finance minister's speech or today's finance minister's clarification press release, it says we are not announcing, we are not legalizing by doing this cryptocurrency. Cryptocurrency, whenever it becomes a legal tender, these are how the finance minister's word, legal tender, these provisions will become applicable. What does that mean? Till the time Reserve Bank doesn't make it official or legal tender, will it be all unofficial currency again, which will be taxable? And if it is taxable, under what provision will it be taxable? So therefore, this becomes a really interesting point for us to debate and take it forward. And what else could be covered under this category of virtual digital asset? I do not know. At least I couldn't understand. At least we are new, old generation people, so we don't understand these new currencies. But anyway, this is what the provision is. Now let's go to another interesting provision. It's a good provision. As you are aware, avoid repetitive appeals. There was a provision which 158A. Only the assessees can file the repetitive appeals. If there are anything appeal, a matter is pending in the High Court or Supreme Court, you can go and file before the lower authorities, and then assessments, appeals may get stopped at that stage. So now, again, you don't have to go through the full process. Now they have said put a restriction even on the government. The government also can do by formation of collegium, 2 commissioners or principal commissioners, and they they are of the view the similar question is available in the assessee's case. And subject to taxpayer agreeing, they will not file the appeal in the High Court or higher authorities. And to that extent, whatever decision of the High Court or Supreme Court will become binding. I think this is a welcome provision. So at least the department filing repetitive appeals, and you have to keep defending and appearing before the tax authorities can get reduced if the department seriously, because it is inverted commas, seriously government works on this. Because today what seriously happens only in the disposal of cases by the tribunal in case of tax, if it is below the tax limits prescribed, it gets thrown away. So that High Court, Supreme Court, tribunal just throws away those provisions if that monetary limit is not satisfied by the department. So now this will be an opportunity for them to reduce their litigation and not get their appeals thrown away. So this could be an opportunity for them to keep the issue alive based on the whatever Supreme Court or High Court later on decides. Now, this is a good provision, but they, as I said, they must use it sensibly and sincerely. Next important provision which I was referring to is a faceless assessments. All of us are aware, on 13th of August, Prime Minister announced that I am going to make announcement for the faceless scheme which is to be brought in the country. Now, was anybody aware of this scheme, either in the department or assessees? Nobody was aware. Nobody was geared up, and scheme was launched. It took almost a time, almost a year and a half for tax administration to gear up themselves and allocate the people from various places as to which officers to go, that commissioners, the hierarchy of that and everything. But the way it was conducted and the way it was managed was created a total chaos, and it became, so as I was saying, became a senseless assessments. Because the way the whole thing was there, they will issue show cause notice to you. They will tell you, you file the reply of voluminous data by 6 o'clock in the evening. You do everything and file by 6 o'clock in the evening. They will not even bother to reply, see the reply, and they will pass the orders. And because of such type of things, what was happening, and there was no video conferencing. There was no permission to ask for conferencing, neither for assessment nor for appeals. And because of which, several matters went to the High Court, and High Court struck down all these orders. They say, if you are not given sufficient opportunity to assess it, to explain, and after giving, you are not giving, even considering what the submissions are, these are all assessment. They set aside the assessment. Some cases they cancelled the assessment. The first time the issue came up before the Bombay High Court and Delhi High Court in case of faceless appeals, because identical provision was challenged. They said, how can you have appeals without giving opportunity to me to explain what I want to explain? And then that case, after this being struck down, government filed an affidavit to say that we are amending our provisions and we will make the give permission to give the hearing, video conferencing, virtual hearing will give to the assessees, whoever wants it. So that was the affidavit filed for the appeal. The same provisions, whatever they have been mentioned in the affidavit, has been brought in the now for the purpose of assessment also. So now whole provision, if you see the whole provision connecting to 144B has been modified. Whole provision has been modified, and that has been modified with effect from 1st April 21 to get over whatever illegality happened in those orders and those regularizing those provisions. How will that be regularized? Those who are struck down by the high courts or which are cancelled, I do not know what will happen, but now that has been done. Another important provision is, and wherever it was earlier a good provision to say 144(9) was there saying if there is any fault in conducting all these proceedings, then order is non-est. That provision has been deleted because they realized that a lot of provisions are getting orders are getting non-est because we are not able to comply with the provisions. So that provision has been deleted. So the whole provisions connecting to 144B has now been amended. So we'll have to really look to the new set of provisions of the this faceless scheme and see how that is going to work. And also they have deferred the provisions relating to the tribunal and DRP and transfer pricing cases, which was to start as a faceless from 1st of April 22. That has been deferred for 2 more years because they have realized that they are not geared up yet. They can't even handle the CPC properly. So therefore, they don't want to add any more problems and any more cases and to get into all these litigations. Now, another interesting provision is reassessment provisions. At least many of you must have realized there are a host of litigations, and I am aware of more than 1,000 cases in and around Bombay and Delhi, which can challenge the validity of reassessment provisions. Now, all these provisions which are challenged has many courts have struck down these provisions reassessment because you have not followed the procedure which is prescribed in 148A. Because after the provision became applicable, first of all, if there is a provision prior to 31st of March, there is a different set of provisions. If it is after 1st of April, there is a different set of provisions to apply for 148. The department was not following these provisions and they were recklessly doing reassessments and without following the proper procedure. So what they have done now, and if you are those who have studied that reassessment procedure, there are several lacunas as to the period of 3 years and 10 years, which cases 3 years can apply, which cases 10 years apply, and what is meant by found in the case of in the form of asset, expenditure, or entry in the books of account, whose books of account, which year. So there are several ambiguities in that provision. So now that they have dumped the provision and they have revised the whole provision of 144 and now replaced by new 144 provision of new provision of 148, and now the new provision clearly says what the new provisions is going to be applies. And as per that provision now, new set of provisions, you have to understand, learn the entire process of these new provisions, what is going to happen and how that is going to work out. And according to me, it's going to be a big challenge for all of us to again go back to the old provisions, because some of the provisions are retrospective, retroactive. So we'll have to see implications of those, how provisions which are challenged, the courts are going to get struck down, get superseded or overruled by these provisions. Again, as I said, I could not figure out what is going to happen and how this is going to figure out. The next provision, which quickly I'll touch upon because I think we are running behind time. We are running behind time. So, is rest set of provisions 11 and Section 2023. As you are aware, Section 1023C grants certain permissions or grants some recognition for certain educational institution, trust, or hospitals or everything, which carries out certain activity of importance. But parallelly, there are provisions of Section 11 which may or may not apply to such 1023 sections. So there were a lot of overlapping, a lot of difference of opinion on the different provisions. So what they have tried to do, now they have synchronized both the provisions and both the provisions are brought on par. So therefore, I don't want to spend your time. Those who are interested can get into the details and see what the provisions of this trust and how they are rationalized. So rationalization, which they have talked about, this comes under this category of rationalization. Then next two important amendments I think we should keep in mind, and some good, some bad provisions have come in this also Tds provisions, which we need to keep in mind. Now, first provision which is come in is in the respect of rationalization category, is for the national in the non-filer cases. As you are aware, if TDS, you have to deduct TDS, then you are supposed to ensure that payee has filed his returns regular. If he has not filed the returns regularly, then you are supposed to deduct TDS at a higher rate. And this was becoming an impossible task for any payer to find out from him or take a declaration. And the period was of 2 years. Now they have reduced to 1 year. I do not know how by doing this is improve the situation and how they're going to create any relief to the taxpayers who are doing the responsible job for the government of India. You do responsible job for government of India, and if you fail on getting certain deductions or getting certain declarations or something for payers, or keeping track on whether he has filed the returns properly or no, then you should have deducted tax at a higher rate. If you are not deducted, then you will be subject to all these rigors of lesser deduction or non-deduction of tax and create difficulty. Other interesting provision which is there is TDS on the purchase of property, which is which was applicable. Purchase of property under 194 IA was applicable to everybody, but now that has been exempted. Individuals and issuers for making payment, that has been exempted from this provision. I think it's a welcome provision. And one clarificatory amendment has been made. According to me, it was not required, but they have made it clarification. If it is 1% TDS has to be done on the ready, always what we knew was the ready reckoner value. So now that ready reckoner value has said that if the consideration is higher than the ready reckoner value, then TDS will be 1% on that. I believe always that was the intention, but anyway, that is what has been now sought to be clarified or brought as a clarification amendment. The next set of amendment is in the TDS appeal. This is in respect of payment made to non-residents. As you are aware, many cases, foreigners say that what you pay to your government of India is not my problem. You pay taxes, whatever is required to pay, and short, less, it is your problem. You give me my net amount. If I want my 100 rupees royalty or 100 rupees as a patent fee, give me 100 rupees. If there is payable, tax payable or not payable to government of India, it is your problem. So there is called tax protected contracts, and therefore it had to be grossed up, and you have to pay the taxes. But many times it was happening was as per the treaty or as per the declarations given by the payees later on. It is found that you have paid excess taxes. There was no provision to claim such refund. That has now been sought to be rectified, but provision is made little long-term provision. It says that now you have to make application to the officer. I made a mistake. I have deducted extra for these reasons. So please grant me refund. If an officer is supposed to pass order within a period of 6 months from making this application, and after that application is made, if it is not acceptable, then you have to go through the normal provision of appeal litigation provision. So that's I think is a welcome provision, though it is 6 months delay, but it is fine because anyway commissioners don't pass order so quickly, even if you are filed under 248. We are aware last 2 years hardly any orders are passed by commissioners because they don't know how to go ahead with this faceless scheme, and so much ambiguity whether to give video conferencing, not video conferencing, because of which virtually not even 1 to 2% orders have been passed by commissioner appeals. So therefore, all that is a standstill. Anyway, so this 6 months is really doesn't go to make difference. So this will be addition to that waiting period. So that's how we have to take it up. Other important provision which has been brought in is in case of cooperative societies. I do not know how many cooperative societies pay taxes. That AMT, what we call it, alternate minimum tax, they have to pay, which is was 18.5%, but company it was LLP it was 15%. So now that has been brought into 15%, both cases, and surcharge has been reduced to 7% if the income is above 1 crore but less than 10 crore. So this is again welcome provision. But I don't know, except few banks or something, I don't think so there is any important people who are paying any cooperative societies who are paying taxes. Then there is a rationalization of certain provisions. Slum sale, goodwill, they made last year the amendment, and there were some flaws in the provisions which they have now rectified those flaws. I think anyway it's good to have at least a rectification done, and most of these provisions are made retrospective, rightly so, because there is a flaws in the provisions itself, drafting itself, that they have rectified. The next important point which to be kept in mind is the extension of definition of 56.210, which is what we call popularly known as gift provision in the hands of taxable in the hands of recipient or donee. Earlier, only certain limited assets were covered in that definition, like land, building, shares, and securities, etc., and jewelry. But now that has been extended to archaeological collections, drawings, paintings, sculpture, or any other work of art or bullion. So therefore, this definition has been considerably extended, and therefore we need to be careful while examining the applicability of Section 4 gift provisions of 56.210. Then there is a penalty provision which has been enlarged, scope has been enlarged, scheme has been there. Now powers has been given to CIT appeals to initiate certain penalty provisions, and which account to me in the par with earlier provisions which were there under the other provisions, 271C and everything which was available. This is extended to. But the other one is penalties for defaulting, furnishing certain returns, including withholding tax and collection at source, has been enhanced from 100 rupees to 500 a day. I think this is very, very punitive, and there has to be some upper ceiling. And my belief is there is an upper ceiling, but somehow I could not lay my hand exactly whether this upper ceiling is to the restricted to the maximum amount of payable to certain amount of percentage of tax. I'm not sure whether it is there or no. And then there is a penalty provisions introduced for passing on any unreasonable benefits to the trustees specified in the charitable institution. That has been quite severely been made, and that could be a point. And there are a few provisions connecting to gift city, Ahmedabad gift city. So there are some liberalization further made more attractive, but still people don't seem to be taking the advantage of it. So therefore they have made more liberal. So friends, these were some of my thoughts on the provisions based on my colleagues, what they briefed me, or colleagues what they prepared slides and given to my presentation. So as I said, thanks to them. And I have tried to put it to those who want to use these slides, they are free to like this is a branch can do and give it to all of you. And thank you very much for giving me opportunity to connect with my friends, contemporaries friends when I used to come regularly to Nasik, and second generation, their children who are now in the practice and doing very well, connect with them at least through virtually, with my promise that whenever things are better, I'll definitely come personally to Nasik and meet all of you. Thank you very much. Thank you very much for patient hearing. Back to you, Chairman, sir.
Yes. Thank you, sir. It was really a pleasure to hear you after a very long time. And as you said, the budget was more of a bureaucratic budget. And seeing the harsh provisions under Section 68 and 40. So, considering those harsh provisions under Section 68 and 14A, I think tax practitioners like us would be having a very difficult time facing all those things in the assessment proceedings. And again, we have to be very careful while using any loophole or a benefit, because you don't know when the retrospective amendment will come. Sir, we are eagerly again waiting for you in Nashik to have a physical seminar and to hear you in live auditorium. I now request if any members have any questions regarding the budget to Rajan sir. So please, you can unmute yourself and please raise your questions.
Sir, I have one question.
Yes.
If SSC has received a notice under Section 148, and after that, can you go for the revised scheme of application of return, or you cannot go?
Sorry, Niken, we are not able to hear you clearly. Can you just clarify a little loudly?
Yeah. If a notice has been received under Section 148, and after that, can SSC opt for this application of return scheme, or you cannot opt?
So according to you, that update, what we call it, revision of return, you are talking about revision of return?
Sir, I'm talking about demand notice under Section 148.
No, under you are asking for clarity as to what provisions?
Application of return.
Yes, updation provision. What is prohibited is only specified in that section itself. If you refer to the provisions, what is prohibited, you can't do the updated return. Is I'll just read out for you. Reassessment notice. If it is reassessment notice received and proceedings are pending or completed. So if notice is received before you file the updated return, then that is not permissible.
Okay, sir. Thank you.
Because it is mentioned specifically pending or completed.
Okay, sir. Thank you.
There is one question in the chat box. I'll just read it for you. Virtual digital asset be set off against gain in virtual digital asset.
That's again area which I said that still no clarity, because within that source of income, can I set off and offer only net income? According to me, should be possible, but the way wordings are, possibly that department you will be no, will not allow it.
Okay, sir. Sir, I also have one question. Now, now there is a scope to file an updated tax return, but what if the assessee opts to pay tax by self-assessment tax and doesn't file updated return? In that case also, do we need to pay that additional 25% and 50% of the tax liability? Or will it be subject to further penalty since I have not filed any updated return, just I have paid essay tax?
No, so now point is that tax has no value because your return still remains the old return. Suppose you have filed a return of say 10 lakhs rupees earlier, and now you have paid tax for additional 2 lakhs rupees. Let's assume that on the 2 lakhs rupees.
Right.
You will not get credit for that because there is no return. What will they assess you?
Exactly.
You need to have the return to assess you in a particular way, either by a return, or if you not revise return, you have to file the at least the offer something by a letter, which we used to do earlier by offer by a letter.
Right.
Or many times we used to make a claim for expenditure.
Right.
So therefore, unless you do that, so they have to regularize by 148. But if you 148, then you have lost the chance of revision of your return, updating of your return.
Right.
But Rajan, can we file the letter seeking that 148 notice may be issued?
But then you will be losing on your chance to do that, no? Then all consequences will follow.
right now what we are doing, if any time bar return is there, then we file a return, maybe invalid. Then we say write a letter to the assessing officer saying that this is a return which is time barred. Please regularize it by issuing a notice under 148.
Yeah, Praveen, very important point. Praveen, what you say is an important point. Point is, if you do that, what will happen is you are out of the new provision. You continue to be governed by the old provisions.
Yes.
So in that case, if you are offered some income, if you fall under the category of the under assessment or escape route, that whatever so-called concealment, then you will be liable under the concealment provisions.
Yeah, but then if there is a genuine mistake.
No, I agree with you. Point is, if you are confident about falling under either of the exceptions provided in those sections, then I agree with you.
Okay.
But if you are not confident, it could be taken as under assessment.
Otherwise, it will be, if it's a surrender of income,
that's right.
Then definitely I will be liable to pay.
Absolutely.
Maybe at 200%.
No. If it is genuine mistake, I fully agree with you, Praveen. But point is, suppose there is something, I have made a mistake in the calculation. Not income I escaped. Suppose something I discovered later on. This income remained to be offered. I am referring to that. Suppose 26 AS comes later on and then you find out that some income was there which you forgot to offer it. If you go on such income, I can hear you.
There may be some case where suppose because of certain problems a return could not be filed.
That's right.
Because of certain contingencies. Because
Praveen, your voice is cracking. Praveen, your voice
then
is
in that situation,
see,
there cannot be certain contingency.
Praveen, your voice is cracking.
Okay. But what I can
you could repeat it again one more time.
Yeah, slowly. If you could just slowly repeat, we'll be able to understand.
Okay. If there is a contingency like suppose a person dies and his wife could not file a return for say 2-3 years, and then she tries to file the return, then in that situation, whether this type of filing of return would be more beneficial.
Yeah, I agree with you. No, so there are both situations we'll have to evaluate. Can the penalty be levied on the legal heir? First of all, if you go on the normal route, will penalty be levied on the legal heir? And or we should go for a simpler way of going out of this updated return scheme and be sure about this only 25 and 50% we pay and finish it off. So that's a choice we'll have to make. Depends on that. But I agree with you. There is a possibility of choosing between the old and new provisions.
And this is again, I think, is an optional provision, no?
Yeah, there's not mandatory. It's not mandatory. Option is given to you.
Okay.
Suppose, just continuing from your point, suppose I notice that mistake, but still I don't do it. Then officer realizes he can proceed with the provisions of penalty provisions, no? Suppose something is there in the AR or 26 AS. Which you noticed it, but you did not revise it. An officer realizes it. Then he can proceed under the regular provisions.
Yeah, but then that is, that will expose me to the penalty.
Absolutely. Same like suppose deceased case. Why I said deceased case is a better case, because at least there is a bona fide reason, because she was not aware of the issues. She has got the details, and the courts are quite considerate on levying a penalty on the legal heirs. Yeah, but I think I agree with you. Their choice is there. It is not something mandatory provision.
Sir, continuing with this, there is a point given in the chat box that there is also an option available to file delay condonation to CIT to file the return. So would that run parallel with this? As you said, it is optional to file updated return.
No, so sorry. What is that? I am not fully conversant with that provision for condonation of delay for filing return by under what circumstances?
119, one can go to CIT and ask for delay condonation where the time limit to file return has been lapsed and there is some genuine reason.
So there is a refund cases. These are refund cases
or death cases or something like that.
Yes. Loss cases or different cases. There are only specific. So that again is a separate provision. because there is no income offer. On the contrary, you are asking for some refunds.
Right.
You are right. That provisions is again separate parallel, as Praveen was saying. So there are multiple parallel provisions. So that 119 is the concessional treatment. For
Right.
refunds, you are not filed the returns, and now you want condonation to be done by the CBDT or Chief Commissioner, whatever that is. Or where lost returns are there, you are not able to file, whatever reasons are. So all those cases can come under the exception clause. And again, need not go, because you can't go those provisions under this, because it can't result in refund. It has to be more. It can't be lesser. Like 264. 264, you can go only if there is something beneficial. 263, you can't ask for, or 147, you cannot result in your refund case.
Exactly, sir. Yes.
It has to be positive.
Right, right.
Rajan bhai, if,
Yes, please. Yes,
if
yes.
I am individual
Yes.
and for filing updated return, if I file my updated income comes to 5 lakhs, below 5 lakhs, so there will be no tax liability. So how to?
No, so there is no tax payable, no? If there is no tax payable, then you don't have to file, no? No, but then question is, if you have refund there, what will you do? Then you will have to go under 119.
That's only alternative.
Subject to the limitations prescribed. And suppose you file the return on the regular course. Let's take a case of what Praveen was saying, same case. You file the return regularly. Will officer issue 148? Because he has to issue refund. He will not issue notice 148. Then what do you do? Then you have to go under 119 only.
119 C18.
Because he will not issue anything 148 to grant you the refund.
Sir, again, I think related to this, there should be some clause in penalty section 270A also, that it would not be treated as underreporting of income if you declare it in updated return. I think that they have not come up yet. So maybe.
No, so I'm saying more we read, we are getting more confused. Well, these 84 amendments, whatever we could understand in whatever limited time, is so much to understand. And every time we read, we find something new things we are discovering.
Right, right.
Only I do not know, even CBDT has realized so many complications they have created themselves for the for provision. Leave apart finance minister.
Yes. Yes, any other query? Right. So I now request our branch secretary, Rakesh Pardeshi sir, to give formal vote of thanks. And thank you, Rajan bhai, for it was really pleasure to you. Yes, over to you, Rakesh.
Thank you, Abhijit sir. Thank you, sir, for giving such a wonderful analysis of a budget and all the required provisions which have changed and which will make impact in filing of returns. Thank you for that. Such a wonderful session. We got very minute knowledge from that. I also thank all the members for participation in this webinar. And I will also like to special thank Uae branch chairman and Uae members for joining these sessions. Thank you. Thank you all.
Thank you, sir. Thank you very much.
Thank you. Thank you. Thank you.
Thanks a lot.
Thank you. The session is over now. Thank you very much.